So you've definitely heard the term options trading, right? It gets thrown around all the time. And yeah, it sounds super complex, maybe even a little intimidating, something only Wall Street pros mess with. But what if I told you it's actually way simpler than you think? Let's spend the next few minutes stripping away all that jargon and getting right to the heart of what options really are.
So what is an option anyway? You know what? Let's forget stocks for just a second. The best way to think about it is like a reservation for a great table at a restaurant, or even an insurance policy for your car. See, you're not buying the car itself. You're just paying a small fee to lock in a certain outcome for later. With an option, you're basically controlling the opportunity to buy or sell a stock, but without having to own the whole thing.
All right, building on that, here's the more official definition. Now, the two most important words on this screen are right and obligation. An options contract gives you the right to do something, to buy or sell a stock at a price you've already agreed on. But, and this is the key part, you have no obligation to actually do it. If things don't go your way, you can just walk away, let that reservation expire. That flexibility, that's the core of what makes options so powerful.
Okay, so now we've got the fundamental idea down. Let's get into the mechanics. And honestly, it all just boils down to two simple directions, two basic bets you can make on where you think a stock's price is headed. And here they are, the two sides of the coin. A call option is your bullish bet. You buy one when you think that stock price is going to go up. It gives you the right to buy that stock at a fixed price. On the flip side, a put option is your bearish bet. You grab one of these when you think the price is heading down. This gives you the right to sell the stock at a fixed price. It really is that straightforward. Calls for up, puts for down. Now, every single options contract is built from these three key ingredients. The strike price, that's your locked-in price. The expiration date is the deadline, the day when the contract just vanishes. And the premium, well, that's simply the price of the contract itself, the cost of making that reservation. Every option you ever see will have these three parts.
Okay, so we know what options are and what they're made of. But, a trade takes two to tango. For every single person buying an option, there has to be someone on the other side selling it to them. So let's take a look at these two very distinct roles.
I think the best way to understand this whole dynamic is the speculator versus the house. The person buying the option, that's the speculator. They're paying a small premium, and they're betting on a big, dramatic price move to make their contract valuable. The great thing for them is their risk is capped. They can only lose what they paid. Now the seller, they're the house. They collect that premium as income, and they're betting that the stock price will just stay calm, do nothing, and the option will expire worthless. They win more often, but they're the ones taking on much, much larger potential risk.
So here's the million-dollar question. Why do people even play this game? What are the big strategic advantages? And maybe more importantly, what's the number one risk that everyone, especially beginners, absolutely needs to understand?
Well, this pretty much lays out the three main reasons. First up is leverage. With just one contract, which might only cost a few $100, you can control 100 shares of a stock. It's a way to really magnify your firepower. Second, there's income generation. This is the game the house plays. Sellers collect all those premiums as a steady stream of income. And finally, hedging. You can use options, specifically puts, as a literal insurance policy to protect your entire portfolio if you think the market is about to take a nosedive.
But, and this is a huge but, with all of that amazing potential comes one massive, unshakable reality you have to respect. And it's this: options are decaying assets.
This might be the single most critical concept to grasp. See, unlike a stock, which is ownership you could hold for decades, an option has a ticking clock. That expiration date is always getting closer, and every single day that passes, that option loses a tiny bit of its value. We call it time decay. For the option buyer, time is the enemy. It is always working against you. So it all kind of boils down to this one fundamental question. Knowing the basics of calls and puts, knowing the balance of risk and reward, and knowing about that all-important ticking clock. Which role fits you? Are you the speculator paying for a shot at a huge win? Or are you the house collecting that steady income and just betting that time will run out? Answering that question for yourself, that's the real first step on any journey into options.